Welcome to the weekly video update, where I'll go over the action in the market for the week of November 13th through the 17th, and then we'll see how things look for the week of November 20th through the 24th. If you only watch the weekly videos, I want to send you a nice happy Thanksgiving ahead of time. My hope is that you'll also tune into the daily videos. I think those do the most benefit for folks, but I realize everybody's busy. Everybody is involved in the market in a little different way, and so that may not fit into what you necessarily want to do. Before I get started, please know that I do post a PDF for every video that I post. It's not only the slides that you see right here, it's also the charts. And sometimes you can download that and follow along as I'm talking. You might see things a little better. Maybe you're watching it on a phone and you can look at it later on a bigger screen, and that might help you. I do that for the purpose of trying to give you an additional tool that you can use for analysis. I do post the pivots every day. I update that each day, but it's only on the YouTube channel. There's a community tab there. If you click on that, there are pivot points that only apply to that particular day. And then there are also pivot points that apply for the whole month. I still update both of those charts each day. I do have a private Facebook group that you're welcome to join. There's not an awful lot of activity there. I've had a little more back and forth lately that I'm really enjoying, but if you want to come and join that group and do some back and forth, I'm more than open to that. I will be posting a new poll after I get done with this video. I'll also be going through the results of the most recent poll. And then I really watch YouTube comments, and I've been starting to get more garbage on Rumble too. So I go through and I delete it. I have that locked down a little bit more, so the garbage stuff doesn't even get posted. Where on YouTube, it's still pretty open, and I have to check that, and I watch those things really closely. I want back and forth between us. If you have a legitimate comment, whether you agree, disagree, that's fine. It's the spam comments, the bot comments, the crap comments, those I want gone off of there. I want to maintain some integrity on both of the channels, and so I try to be really vigilant about watching those things. And I also post videos on Rumble as well, and here's the link. Sometimes if you're having trouble finding the video on YouTube, you can jump over to Rumble. If you can't find it on Rumble, you can jump over to YouTube, just as kind of a backup. Let's go back and talk about the week session. For the week, we were up 2.24% on above average volume. Now, a lot of the days this past week on the daily charts, we've been below average. But when you look at the weekly chart, we're still slightly above the moving average that I use to measure that. And the technicals are looking more positive. We've had a couple of pretty solid up weeks now. And so that's helping the overall picture. We are looking in the short and intermediate term on the daily charts. We're looking overextended to the upside. So we always have to be careful of that. But to this point, we haven't really seen a big pullback. And if anything, the market's gone into kind of a comatose state and is just kind of drifting sideways, which could be positive in and of itself. We always have to be concerned about some kind of black swan event that can come in. There's a lot of geopolitical things happening. But one thing I would recommend is, if you look at these things over history, like 9/11, we were already in a downtrend, and then we got hit, and we kept going down after that. Then we had the COVID plunge. Well, we were in a really solid uptrend before that even happened. Yeah, we tanked, and we tanked bad. But once we finally started to bounce up, we regained that and just kept going up after that. The market has a tendency to resume the bigger trend when something flies in at the market that is counter to that trend. We saw that during Brexit. We saw that during the 2016 election. Those kinds of things that will gyrate, in interest rates are another thing. But the market will typically resume the trend that it was in before. It might take a little bit of time. Now, it doesn't mean that's always going to work out that way, but the research that I've done does indicate that. And we're looking more positive right now. We're also coming into the strongest part of the year. November tends to be the best. Now, we're coming into a weak part of November, and we could also see a real drop-off in volume in the upcoming week because it's a holiday week, and the market's going to be closed on Thursday. There's going to be an abbreviated session on Friday. We saw below average volume this past Friday, and that was options expiration. And that's very rare to see that. But when volume really drops off and some big player comes in and wants to buy or sell, that can really move prices. So we want to keep an eye on things, but we also may maintain this more dead EKG flatline type of scenario that we've been seeing. At least we saw that in Friday's session. We're also dealing with interest rates and inflation. The market seems to be kind of okay with things right now. We're going to get the Fed meeting minutes on Tuesday. I believe it's Tuesday. And they'll be looking for any kind of clues as to what the Fed was saying, how they voted, and the back and forth that was going on. Sometimes that can be a market mover. And then we have the geopolitical concerns. What's going on in Israel is kind of the main thing right now, but will that escalate? We didn't see as much hedging in Friday's session that we have seen over the past couple of weeks. I don't know. It's kind of leaving the news cycle a little bit now as this kind of draws into a longer drawn out conflict. So we'll have to see if it's going to have the impact. Now, that could always change at any time. The condition of our trend, this is where we're changing right now. In the short term, intermediate term, and now on the weekly charts, the very long term, we have now switched back over to a positive trend. The green line is on top. Now, on the weekly chart, the ADX is below 20 and it's below its moving average. So that's a weakening trend. So we want to be aware of that, but it has switched over from negative to positive. For the week, the Dow was up 1.9%, the NASDAQ was up 2.4%, the S&P was up 2.2%, and the Russell, the small caps, they had a pretty good week. They were up 5.4%, but we've seen this before. They've shot up and then spent the next number of days giving it back. They shot up earlier in the week. We had a couple of down days, and then they ended up having a good day on Friday. So for the week, the S&P did close above the 4,500 level. It was not so long ago we were dealing with the 4,400 level. We got above 4,500 and we were able to stay above that. So that is positive. The 4,600 level might be kind of some resistance though. We want to be able to break through that so that the chart patterns that we see are showing a series of higher highs and higher lows. That's more what happens in a bull market. There wasn't an awful lot of selling after the big run that we saw, the run up that we saw a week ago. And that can be encouraging. You didn't see a lot of profit taking. There was some. Sometimes the mega caps were a little bit weaker this week. Sometimes the rest of the market was a little bit weaker, but we didn't see anything that was all that crazy. And then FOMO, the fear of missing out. You have a lot of people. Just a few weeks back, we were going down and we were going down fast. We hit some support and we're able to bounce up off of that. And people were like, yeah, we're going down. Plus, there's also, some people have a tendency to be more bullish and bearish. And it seems like if you're bearish long enough, eventually you'll be right. But if you look at a long-term chart of the stock market going back 100 plus years, you'll see that for the most part, it goes up. Yeah, there are down times. So my recommendation is to be a realist. There are times when the market goes up. Sometimes you can't even explain why. There are times when it goes down, can't explain that. And there are some times when it goes sideways. We have to look at all three scenarios at the same time and be prepared for all three, just in case something does happen and we're not caught off guard. But you have a lot of folks that are seeing the gains that have been coming into the market, and they're like, oh my gosh, because they tend to do things on an emotional level, not necessarily a logical level. And sometimes when they start jumping into the market based on emotion, yeehaw, that may mean some kind of a top or at least a slowdown. They get frustrated. They thought, okay, we missed this one. They get out and then the market ends up going up. Or something like that can often happen, but that may be entering the market. Seasonally, it is a strong time of the year. November's the best month of the year, according to the Stock Traders Almanac. And it is pretty good. And I'll have some charts at the end to show you about that. And December tends to be pretty strong too. The mega caps and the broader market did see gains this week. Some days the mega caps did better. Some days the broad market did better, especially in Friday's session. It was good to see the small caps and the mid caps do well. The CPI, the PPI, retail sales, they were all taken together as positive. We're kind of going with this scenario now that the market is not, or the economy is not too hot. It's not too cold. We're in kind of a Goldilocks time right now. Economic reports are coming in showing growth, but not too much growth. If they start to get weaker right now, that's good news. But if that continues along that way, pretty soon bad news will turn into bad news. But that hasn't happened at least yet. And the reports that came out were seen as positive. Interest rates and the dollar were down. So this helped give some support to stocks. Rates going up and the dollar going up, those often provide headwinds. When they're going down, that can provide a tailwind. Congress did end up passing a continuing resolution. Yeah, you think they wanted to go home for Thanksgiving? Of course, they wouldn't jeopardize their own vacations. So we were supposed to hit a deadline next week. This is the whole shutdown that we saw, what, a month or a month and a half ago, something like that, that everybody was freaking out about. They kicked the can down the road until this upcoming week. Well, so they didn't jeopardize their vacations. They ended up just passing a resolution. And then this past week, President Biden was meeting with President Xi. Look to the White House website or something to try to translate what was said. Not so much for President Xi, but President Biden, since you can't understand what he's saying most of the time. The markets will be closed on Thursday, and they'll close early on Friday at 10 p.m. Eastern time. If you live on the West Coast, that's pretty cool. You're done working at 10 a.m. that day. And this is in observance of Thanksgiving. Here is the VIX that we've been following, where we topped out in October, and as this is going down, that tends to be more positive for stocks. But there are times when this does hiccup and go back up when we look at the average from 1990 to 2022. And so that's why I have a question mark here. We don't know if we're going to follow this completely. This is just kind of a guide that we use to give us an idea where the VIX tends to decline now going into the end of the year. We're also keeping an eye on inflation, and this is a chart from the end of June. So it's, my gosh, 5 months outdated, but it's a very long-term chart. It's comparing inflation from 1966 to 1982 with what we've been seeing so far right now. Now, if we try to update this a little bit, we're still in this area where inflation is going down, and the market likes that. Be aware, though, what happened after that? We saw a spike up in inflation, it leveled off, and then you get into the hyperinflation of the 70s. Is something like that going to end up happening again? We don't know. We just use this as kind of a guide. Then looking at some research, and I go through this every day in the daily video, Renmac put out this research suggesting that when interest rates on the 10-year are at 4.02% or above, that's when it starts biting into corporate profits. So we've been following the 10-year yield, and right now it closed at 4.44%. We were just battling 5% not very long ago. Looking at the poll results, the first question, oil has been, now this is a week ago when I created these questions. Oil has been falling lately, and the stock market does not seem to be as focused on the price of oil as it was a few weeks ago. And it kind of still seems to be that way right now. Do you feel this will continue, or will oil prices go back up, causing concern? 33% said that will continue, which is kind of what has happened, where 67% thought that we were going to go back up with oil and that was going to freak out the markets. It didn't end up playing out that way. The first answer is actually more what happened. The equity put call ratio, which had been going up on Fridays and then coming down on Mondays because people were hedging over the weekend. If you're long a position, you might buy some puts, but that'll bite into your overall returns. Plus, we had a down open on Monday, and you probably could have sold those puts for a profit, lock that in, get the hedge off of there, and now your returns might be even greater. But it has been climbing on Friday, suggesting that the market is hedging over the weekend as geopolitical events unfold, and this is still in the process of happening. Do you feel that this trend will continue, which it didn't happen in Friday's session, which may give us a false insight concerning sentiment, or will we still be able to rely on watching this measurement? Most people think it's not reliable. That's why I use a whole slew of sentiment indicators. I look at the equity put call ratio, but I look at a lot of other things, and some of them I'll go through in this particular video, where 88% said that it is no longer reliable. 13% said it's still reliable. Then the third question, for the week that just ended a week ago, volume was well below average each day. If volume picks up, do you feel it will be to buy or to sell? 33% thought that we were going to buy. 67% thought we were going to sell. Well, we had another up week, so that turned out to be different as well. Then on Friday, November 10th, a week ago, the S&P closed slightly above long-term resistance. That's a long-term trend line that we've been following. Do you think the market will go up from here or lose this resistance level and fall? 41% said that the S&P will go up. 29% said that we will go down. 29% also said that we will chop sideways. We ended up going up, at least to this point. A couple of charts that I found at isabelnet.com blog charts. This is an estimate of revenues and earnings going forward. And the blue is Morgan Stanley. That's what they come up with. And then the lighter blue is the consensus, what everybody's thinking. And the reason I have a red arrow on here is because they're still projecting out positive earnings going forward, and that justifies stock prices going up. Then this is a newer chart that I don't show all that often. It says the 7 largest companies as their share of the S&P 500 total market cap. So we have the big mega caps. They are 29% of the market capitalization of the S&P. So that's a pretty big thing. And that's why we do keep an eye on some of those big companies, because they can really impact the indexes. Then here's another one. This is more in the sentiment category. Is the recovery in equities, the bounce that we've been seeing, sustainable or likely to reverse soon? 39% said sustainable, 61% said that it's going to reverse. Now, you could use this as a contrary indicator. You got a lot of folks that are pretty bearish on the market, and this is usually when things start ripping to the upside. Not saying that's what's going to happen, but I've seen it happen like this before. So just know that if you're kind of bearish on the market right now, you're in a lot of company these days. There was one post from FactSet that we can go through. It says that there are fewer S&P 500 companies that are discussing inflation when they have after they release their earnings, they have a conference call, and they track they look for a number of different words, and they're trying to see how many times was inflation actually mentioned. And this has really been decreasing as inflation has also been coming down, so it's less and less of a concern. Looking at our charts, here's an intraday chart. We're on Monday. We did gap lower, and that might have been when folks were getting off their hedges. They bought puts on Friday, and then we gapped lower, so they sold the puts for a profit, and then we ended up having a pretty good up week. And then we saw a real strong update on Tuesday. That's when CPI came out. We were pretty much sideways on Wednesday, Thursday, and then we were a little bit higher, but pretty much sideways in Friday's session. So for the week, the small caps actually did the best. We're used to seeing them in last place. This week they were in first place, followed by the mid caps, which have been under a lot of pressure. All of the other indexes ended up being positive. Now, please be reminded that this is only for the 5 trading days of the week. I don't go from Friday to Friday. I go through from Monday to Friday, because we get Friday to Friday readings in other places. Then going back to the beginning of the year, we have the NASDAQ 100, the NASDAQ, and the S&P showing the biggest gains. And now, finally, the small caps had gone negative since the beginning of the year. With this past week, they've gone back to being positive. So all of the indexes are positive right now since the beginning of 2023. Going back to the all-time high, everything is still negative, with the small caps down the most, followed by the mid caps. And we're doing some repairing here, but we haven't been able to set a new all-time high. Looking at the different sectors, we had an up week, plus all the sectors ended up being positive. Some of the areas that have been beaten down lately include real estate and consumer discretionary, which has been strong until we got into the summer. It ended up having a good week. Utilities have been getting hammered. Financial sector's been getting hammered. They had some good rebounds this past week. Staples, which are still under pressure, they were up a little bit, but they were positive on the week. And energy, it's gone up really strong, then it's gone down pretty strong. It ended up being up as well. So all of the sectors in the S&P ended up being positive. So when we look at the relative rotation graph, and again, you have to remember back to your geometry school days, where this flat line here is the x-axis, and the up and down line is the y-axis. When you're on this side of the y-axis, on the x scale, that's a plus and a plus plus. So the strongest areas of the market are going to be in the upper right-hand corner. And energy, even though it's been coming down, it's still one of the strongest sectors. We've also been seeing communication, as well as tech, and even the financials are showing a little bit of life right here now. So that is showing some improvement, and we're seeing a lot more sectors than what we have been seeing. Then some other areas of the market are in blue, and they're showing some improvement, where we have the industrials and then the staples. They're the ones that are looking weaker right now. They're more defensive, they're more value oriented, and so that's why we're seeing them pulling back slightly. Going back just for this week, looking at the different sectors, real estate, which has just been getting hammered. Utilities have been getting hammered, materials, financials. These were the stronger areas. So folks were trying to buy low with the hopes of eventually selling higher, where we had healthcare, energy, and staples ended up being down for the 5 trading days of the week. Going back to the beginning of the year, here are the three biggest or strongest sectors: tech, communication, and discretionary, which had been stronger, and it's trying to make a bit of a comeback now, but it has really been trailing off, where all of the other sectors are still negative going back to the beginning of 2023. Going back to the all-time high, we have energy, which is still, it's given up a lot of its gains, but it's still the strongest area, followed by tech, industrials, and all of the other sectors continue to be negative. Looking at sentiment, we did see a tick up. Now, one area concerning sentiment, we really only pay attention to this and look at it like a contrarian when we get to an extreme fear area or an extreme greed area. If this is starting to inch higher, we go with that because that's what the smart money's doing and we want to follow what they're doing. If this is ticking down, then we want to go with that too, and we're more negative on the market. But we did cross over into this 58 area. They say it's greed. I call it more positive. And looking at the chart where we did get below 25 and we've been inching our way back higher, if we get above 75, that's when we're extreme. But on this chart, there's still more room to run to the upside. Looking at the active asset managers, they had become extreme negative. Even though these folks are professionals, they're human beings too. And when they were starting to get extreme negative, we were using this as a contrary indicator. Now that it's turning more positive, we can go with that until we get up to this 90 level. That's when they're starting to get extreme positive. And we have another chart of that same thing right here where we're coming in at 72.06. Then looking at the VIX, we are declining when we look at the line chart and the bar chart, and we're well below 20. So we're seeing a lot of fear really coming out of the market. Here's another fear gauge or sentiment gauge that we look at where the Ulcer Index is still above its moving average. It was pretty much flat for this week. We're seeing it really declining on the daily charts. The RIDEX bear bull ratio, when this spikes up, people are freaking out and they're negative. When this comes down, that means they're really happy. We saw a little bit of a tick up here, but we then ended up coming back down, and folks tend to be more bullish right now than bearish. The latest reading of the American Association of Individual Investors were positive. They're above zero, and it really didn't change all that much this week. But we're not getting any kind of an extreme reading now, so we really don't use this all that much. Then looking at cash or the 1 to 3 month T-bills and comparing it to the tech sector, when this black line is going down, that's positive for tech, as it was for so many years here. And then we ran into some trouble in 2022, and the black line was going up. Now it's starting to go back down. That's more longer-term positive. Looking at the economy, the latest reading from GDP now has GDP coming in at about 2% with the latest reading. When we look at the different forecasts, it's about 1 3/4 to the upside to a little bit below zero to the downside. Here's what it shows like, or it looks like on a bar chart where we're looking at the fourth quarter now. We have some numbers for the third quarter, so now the market's starting to focus on the next quarter out. Then this is the spread between risky and not as risky bonds. If this was going up like it was way back during the great financial crisis or during the COVID plunge, then we would be getting nervous. But you see, this is actually going down. So the market's not necessarily freaked out when it comes to this chart. We also look at a weekly chart of the Chicago Federal National Financial Conditions Index. Why do they have to make these names so long? As long as we're below this black line and we're actually declining, that means according to this, the economy is doing just fine. And then we did have an update of the net percentage. This is the tightening standards where they're starting to come down a little bit. Banks are easing up in their requirements for being able to borrow money. We also had a recent reading for the real-time SOM recession rule indicator. I don't know why they call it real-time, because sometimes I go a month without this thing actually updating. It did tick up. It's above the black line, but we only get nervous when it goes above the red line. So we want to keep an eye on this. And then we have the smooth U.S. recession probabilities. We're just barely on the black line right now. We get concerned if we get up to the red line. Then the Brave Butters, this also has not been updated since the end of October, where the last reading that we had has this coming down where it was going up. That was causing some concern, but for the fact that this is coming back down, that's putting the market more at ease. Keeping an eye on inflation, this is Inflation Nowcasting, where every day they update CPI, core CPI, PCE, and core PCE inflation. And as the reports have been coming down, we've been seeing inflation forecasts actually coming down as well. Keeping an eye on the Fed. This is interesting to be so far out from a Fed meeting. They won't meet until the 13th of December, but there's a 100% chance right now, it's probably going to change, that they will leave rates unchanged at the upcoming meeting. To see this convicted of a result this far away from a meeting is kind of concerning. I mean, it's almost a month out. And here's how it has changed, where the blue line is where we're at now. Then we have a day ago, a week ago, and a month ago. As these economic reports are coming out, the market is getting more and more comfortable that the Fed may be done raising interest rates, but that could always change. So we want to stay on top of the reports that are coming out. Looking at the Fed balance sheet, it's continuing to decline. It started to decline in June of 2022. And then we hiccuped here. That was the banking crisis that we saw last March, and now it's continuing to decline. Here's a year-over-year look showing how things are falling off of the Fed balance sheet. Keeping an eye on breadth, we're above the moving average based on price, and we're showing some improvement and trying to get above the moving average based on volume. We're seeing kind of that same thing on the daily charts, where price is looking more positive than volume currently. And then looking at the new highs versus the new lows, we're seeing a real improvement here, where the new highs are outpacing the new lows. And we're seeing that same thing on the daily chart, both with our 4-period moving average and our 10-period moving average. The advanced decline ratio, both the blue line and the red line are above 0 and advancing. That's positive. Accumulation distribution, we're starting to come above the red line. This is trying to gauge what's the smart money doing. We're seeing it show a lot of improvement on the daily chart, and now that's being confirmed by what we're seeing on the weekly chart. Keeping an eye on our trend. Here's the ADX. That's the black line, and it's dropping below 20, suggesting that we're not necessarily in a trending environment. Also, the ADX is below its moving average, but we did finally see the green line cross above the red line. And sometimes when we're seeing a change from a downtrend to an uptrend, the ADX does go into a trendless environment for a while before it starts to turn back up. We're looking positive as well on the daily charts right now. So that's confirming it. When we look at the Erin indicator, this is still negative, but this is kind of a crazy indicator. It'll just sit around and give us no reading for a while, and then all of a sudden it'll just wake up and just blow us with a reading in the opposite direction. The red line is still on top. That means that's sellers, and that means that they are in control. The green line are buyers, and that is declining. That's why we're seeing a negative oscillator down below. On the daily chart, though, we are positive. The mass index is not generating a signal. So when we look at our daily chart, we came right up to this pivot point. You think these pivot points are important? We could not break through that. And when you look at other indexes, they're also running into a pivot point. So yeah, these are pretty important things to follow. On the bottom, looking over the last couple of days, we did drop to below average. There was a couple of days where we were above average, though. And our trend channel, we're still above the midpoint and the long-term trend going back to 2009. Here's the pivot points. This is another reason why they're important to keep an eye on. We came right up to this level at the end of July, and that's where we topped out and then ran into some problems. Well, the market might be making another run. If we come back up to this level, it's still the same resistance level. If we break through that, that could turn things a lot more positive, or it could do what it did last summer and help us to go back down. But when we look at our trend, the 50-period simple moving average, we're above an advancing moving average. That's positive. The long-term trend is positive. When we look at the McClellan oscillator, we're starting to get extreme positive here, but that could also suggest there's good momentum happening right now as well. But we want to be aware of this at the same time. When we look at the summation index, we're crossing above 0 based on price. We've already crossed above 0 based on volume. That is also positive. When we look at the Swenlin trading oscillator, we're above 0 based on price and volume. That is positive. The bullish percent index was able to cross above 50 and is looking better. On the daily chart, even when we have kind of comatose days to down days, the BPI has still been going up. That's a sign of internal strength in the market. Here's the PMO, but when we look at our weekly momentum, we're still negative with the PMO, even though it's trying to turn back up. We did cross above 0 based on price and volume, but we're going to need to see more of that. And the PMO studies, we're still extreme positive with the PMOs that are above, that are rising. And we're also extreme positive on the daily chart. The buy signals are positive, or extreme positive on the daily and weekly chart. We're still positive on the PMOs that are above 0. This is almost identical to the daily chart. This is a weekly chart, isn't it? Yes. Okay. The percent B indicator. We're above the midpoint and advancing. That is more positive. We did not close outside of the Bollinger Bands, at least on the weekly chart. But from a momentum basis, we are showing some improvement here. We're starting to turn back up with our shorter term oscillators and our intermediate term oscillators. We're still going down with our long-term oscillators, where we're full-blown positive on the daily chart. The chicken money flow. This is another smart money indicator. We saw a real spike up in Friday's session, and it's looking more positive. It's still negative here on the weekly chart, but the red line is starting to turn back up, and we are seeing some improvement here. The chicken oscillator is crossing back above zero after being below, so that's turned positive. The force index is above zero and advancing. That's positive. The money flow index, it's still below 50 and actually declined this past week, but we're getting an extreme positive reading on the daily chart, and we don't see very many of those. The rate of change going back 1 week was above the zero line because we were positive. Going back 50 weeks, we are showing some improvement here with the rate of change. The RSI based on 14 weeks is above 50 and advancing. That's positive. And we have turned positive back on the daily special K chart, but we're still declining on the weekly chart. So that's not a confirmation. And I'll have the daily chart to show you later. We're starting to get extreme positive with the Stoke RSI. That's one of our touchier indicators. And our Williams percent R, another touchy indicator, which is looking extreme positive. The ultimate oscillators crossing back above 50 and not extreme. That's positive. The vortex, we still have the red line on top, but it is declining. If these can cross, that would be positive. Now, we are positive on the daily chart, but the green line is way up at this line up here, suggesting that maybe we're getting kind of extreme, or at least due for some kind of sideways action. The Copic curve is positive on the daily chart, and we're crossing over positive now on the weekly chart. And we're still hanging in there with our longer-term fib levels and longer-term support. We're well above all of the moving averages. Our different charts, we're looking positive with the Heiken Ashi, we're looking positive with the Kegi, the Renko is positive, and the three-line break is positive, and we're seeing that same thing on the daily charts. The ease of movement, 14 weeks, we are showing some improvement here, but we're still below zero. We did have a couple of new X's that were drawn in here, and that's positive. Remember, the point and figure chart does not take time into account. It's only measuring price change. And when price actually moves in a certain direction, that's when something gets drawn in here. X's are positive, O's are negative. The last signal that was generated was on October 30th, which is a low pole reversal. Our different trading systems, the Heiken Ashi is now showing, I'm sorry, there's a slip. The Elder's Impulse system is showing us the third week now of being positive. And the parabolic SAR, which changed back to being positive a week ago, it continues to be positive. This is, to me, a more important signal. The PPO studies, we're showing some improvement in the long term, intermediate term, and the short term on this weekly chart. Now, I have a few daily charts to show you because not all of you watch the daily videos. I really wish you would. I think that would be the most benefit. But I realize that people are busy. This is a little bit of a concern to us. This is a 10-minute intraday chart of the S&P growth to value ratio. When we were coming down, that's when the market was going down. And then we had a couple of solid up days and we saw growth improving, outperforming value. But then we had that really big up Friday, like 2 weeks ago, and we saw growth just really tank. That was a warning sign. But after that, we started to see growth outperforming value. The only problem is now that things are turning more positive, we're seeing the growth to value ratio start to decline again. So that's a bit of a warning sign, but this is an intraday chart. Looking at an end of day chart, we're also seeing growth starting to underperform value, but it's still in a longer term uptrend. This is something that we don't see very often. This is the skew index. We mainly follow the VIX. This is another sentiment gauge. Where the VIX looks at the money options, the skew index measures using out of the money options. And when we get up into this red area, the market is expecting some kind of a big move. We just don't really know what that big move is going to be. If you look at other times when we spiked up and started to come down, sometimes it was a top, sometimes it was a bottom, sometimes it was just a continuation. We just want to be aware that this is happening. The equity put call ratio based on 5 periods, it is starting to decline after we were given a really high reading. So this is positive. When this goes down, usually stocks are going up. And then we're well above all of the trend lines right now on our daily trend line study chart here. Here's the daily special K chart where it's starting to cross back above the red line. So that's turning positive, but we're still declining on the weekly chart. And our longer term weekly chart, looking at the arithmetic scale, we're above this trend line going back to 2009. When we look at the NASDAQ 100, you see this pivot level here? This is why it's important to keep an eye on these things. The NASDAQ 100 is just not able to break through that yet. Then looking at the FANG index, a longer term chart where we're getting really close to coming back and retesting the all-time high. We broke above this trend line here that's in green. This red line would be a test of the previous high, and we're getting kind of close to that now. Looking at the broad market, here's the seasonality chart where we focus here on November. We're up 5.3%, 80% of the time for the month of November from 2019 to 2023 so far. Here is a chart looking at the S&P, the mid caps, and the small caps with no studies on here, just to kind of look at price. Where the mid caps had been really starting to underperform, they're bouncing back a little bit, and the small caps are showing a bit of an improvement. The Dow continues to be in an uptrend. It actually generated for a very short period of time a death cross on the daily chart, but we've been above both of the moving averages, so the death cross has pretty much gone away again. So things are turning more positive on the daily chart, and we're still looking okay here on the weekly chart. The NASDAQ is still looking positive. The NASDAQ 100 is looking positive. The mid caps, they're in a death cross here on the weekly chart, but they did end up having a pretty good week. And the small caps also in a death cross, but could be starting to bounce. But we've seen this before. We see the small caps start to get a little bit better, and then boom, they just go down. Is that going to happen this time? The NYSE, which is a broad-based measurement, we're seeing a death cross here on the weekly chart, even though the NYSE was up almost 3% on the week. All stocks continue to be in an uptrend. The 30 biggest software companies had generated a death cross. Now we're starting to come back above the moving averages. So this is improving, but it's still generating a recent death cross. The FANG index, this is one of the stronger areas. This is a weekly chart where the other charts I showed you were daily charts. We're above both of the moving averages, and we're coming back and seeing if we can put in a new all-time high. ARC, it's kind of some days good, some days not so good. It was up 10% on the week. That's a pretty good week. But we did generate a recent death cross. We're also working off of a death cross on the daily charts, but this has been pretty choppy lately. Looking at the bank index, we're looking more positive with the RSI. The MACD is turning back to positive, even though banks have been under a lot of pressure in 2023. The deposits actually are showing a bit more of outflows. It's not really reflected in this chart. This is coming down slightly. You have to look at the number over here where it's minus. And then looking at just a blank chart of the Dow, the transports, and the utilities. Traditional Dow theory just uses the Dow and the transports. And we want to see more strength out of the transports. They haven't really kicked into gear yet. If they do, and there's a pun in there somewhere, if they do really kick in, that could really give some good support to the market, but it just hasn't happened yet. The utilities have been under a lot of pressure, even though they did bounce back up this last week. Some broad market measurements. Here's the CRB index, where it's still in an uptrend, but it's showing some more deflationary areas. We look at oil, which is down around the 76.04 area. We actually dropped down into the low 70s, but oil was up strong on Friday. Copper is looking more like it's coming into more of a downtrend as it's been chopping more or less sideways, but it has also been declining lately. Here's the dollar, which didn't really have all that great of a week, but it's still in a longer-term uptrend, both on the daily chart and here on the weekly chart. Gold is still hanging on to an uptrend right here on the weekly chart, where it's in a downtrend on the daily chart. It really spiked up as the geopolitical events started to hit the markets. And then as things calmed down, we've been seeing gold falling back. And we're kind of seeing that same thing with silver, where we're in an overall death cross here. But that's a longer-term downtrend, but it has been bouncing around lately, but starting to head down overall. Keeping an eye on bonds. Here's the total bond ETF on the weekly chart. It did bounce back up, but we're still working off of a recent death cross. Stocks continue to outperform bonds on the monthly chart. And I brought this up in the daily video because we should always get a negative answer here. When you take the 1 month yield and subtract the 3 month yield, further out, that should be a higher yield. we're actually getting a positive value right now. Now, is something going on? This doesn't happen very often. The last time we gyrated all over the place, that was the debt ceiling crisis. And is something amiss in the market right now? We just want to be aware of this one. Looking at the daily chart of the trends where we have been going up, but lately interest rates have been starting to come back down. Here's a weekly chart showing that the US rates and the UK rates, they tend to be the highest right now, followed by Germany, and even the Japanese rates fell a little bit this past week. Some relative studies. We first look at an intermarket analysis chart going back to the beginning of 2023. Stocks are performing the best, followed by gold and then the dollar. And now energy is starting to come back and be positive again. But bonds based on price, they're showing some improvement, but they're still negative. Here's going back to the beginning of 2022 when we set the all-time high. Oil's in first place, followed by the dollar, then gold, where bonds and stocks are still underwater. Here's the ratio between the NASDAQ 100 and the S&P 500, where the NASDAQ 100 is outperforming. That's the big companies that are really doing well. We look at the S&P 100. Again, the big companies are outperforming the rest of the S&P. Even though we ticked down a little bit with this ratio, it's still in a really solid uptrend. Growth to value is also showing some improvement, even though it ticked down just a little bit this past week, but it's still outperforming in the bigger picture. The gold to silver ratio, we're in a downtrend, and the gold is really starting to underperform the rise in stocks. And gold is also underperforming the rise in the dollar, even though the dollar was down on the week. That's why we saw this tick up slightly. Looking at bonds and showing how they're underperforming stocks on a shorter term weekly chart. And the low volatility stocks, they're starting to break below this previous low that we saw here. If that falls down, that probably would be positive for the rest of the market. Discretionary is continuing to outperform staples. And it's not that discretionary is doing great. It's that staples have been doing really bad. But we are seeing some life out of discretionary lately. Energy to tech ratio, where this is going down, that means energy is underperforming the tech sector. It had been bouncing back, but it's still in a longer term uptrend. Downtrend. Then looking at our trend studies, this is the NYSE breadth thrust, where over a year ago now, we had a buy signal generated, and that remains on the books indefinitely. Then this is what's interesting, and I actually have the wrong chart here. We had a ZWAG NYSE breadth thrust that was triggered last March. Well, I didn't mark it here on this chart. We had one triggered just a few weeks ago, and these are very rare events. But to see two of them in such a short period of time could be quite positive longer term for the market. There's the Horchak. It's still coming off of not giving us a full-blown buy signal for right now. Hasn't been falling anymore, but it hasn't bounced back up, at least yet. And then looking at the log scale chart, going back to the 1987 crash, and then connecting it to the dot-com bust low, where we're starting to come back up to this longer-term trend line here. This may act as resistance. It may turn more positive if we can get above that. Here's a shorter term look at that same chart, only going back to the beginning of 2018, where we're still below this longer term trend line. And this is now acting as resistance. If we could get above that, that would turn things more positive. And then here's the NASDAQ 100, a weekly chart. We're still just a little bit underneath the longer term trend line. Then we look at a ratio between the NASDAQ 100 and the Dow. We haven't come back to this previous all-time high here, but we have been going up. If we hit that and turn down, that could be very long-term negative, but we haven't quite triggered that yet. And then we look at the QQQs, which is the NASDAQ 100, and do a ratio between that and the IWM ETF, which are small caps. And a week ago, we were breaking out with this ratio, and now we're starting to come back down slightly. We want to keep an eye on this too. When we topped out before, that was the end of the dot-com boom, and this whole downward slope that you see here was the dot-com bust. We're also keeping an eye on this. This is longer term. This is the cumulative new highs and new lows for the NASDAQ. It continues to fall, but it's been doing that now for a number of years. So I'm not sure when that's actually going to kick into gear. Down below, if we could finally get above zero, that would turn the new highs minus the new lows more positive, but it still continues to be negative. We're also keeping an eye on this. We don't know if this is relevant. When we topped out with the 3-month yield, that was right before the great financial crisis back in 2007. We're above that level now, and we're starting to roll over. Is that giving some kind of a signal? Unfortunately, these things don't happen overnight. We just want to keep an eye on this. Here's Tom Bowley's research. for the month of November, it's a very bullish month. It tends to be the best month of the year, but utilities are not hot where industrials are hot. We're coming now into the time of the month where we might see some pullback. This is usually during the Thanksgiving week, but we tend to see a real strong end to the month. Now, this just applies to Monday's session. And if you want daily updates on this, you'll need to watch the daily videos, but I also include them here. We are dealing with earnings season. We are dealing with the situation in Israel. The technicals on the daily charts are positive, but we are extreme positive. You could also say overbought. We will get the leading economic index coming out on Monday. And then we're keeping an eye on all the different geopolitical events. If you want to see the whole list here, please pause the video and look this over. Israel's the big one right now. Here's the economic calendar for the week. We will get the FOMC meeting minutes on Tuesday, so I was right about that. And then we're going to get a slug of economic reports on Wednesday. The market will be closed on Thursday for Thanksgiving. There are no reports coming out on Friday, and it will be an abbreviated session. Here's the Stock Traders Almanac statistics for November 20th, where November tends to be the best month of the year. We have now finished options expiration week, and we're in the week after that, where we're up a little, about 62% of the time, and down about 39% of the time or so. For November 20th, the Dow is actually negative, where the S&P is neutral to negative, and the NASDAQ is neutral to positive. And I don't know why this didn't quite line up here. I've switched back to PowerPoint, and I usually create these things using Google Slides, and sometimes the spacing doesn't work out all that well. But we're running the whole gambit here as far as historically what has happened from 2001 to 2021. We will be on the 14th trading day of the month, where we look at the green dashed line for the S&P, where we do see some historical weakness for the next few trading sessions. And then here's the whole month. This is when the current president is running for re-election, which we tend to be positive. There's another seasonal chart where the red line, it's a little outdated now, where we're coming more into the positive part of this chart. And then we look at the average year from 1950 up to 2022, where we tend to be more positive in the longer term. And then this is interesting, where everybody thinks that a pre-election year is automatically going to be up. But according to this, put out by Goldman Sachs, the pre-election year actually underperforms. That's the blue line here, where it tends to underperform the non-presidential election year. Yeah, they're both still positive, but that's kind of the cliche that the market goes with. Well, how can we be down and it's an election year? Well, it may be up, but it tends to underperform other years. Here's some Carson research. This is a relatively new chart where they just say the end of year rally is here, where we might see some weakness going into the latter part of November into December. And then we tend to see some good strength going into the end of the year seasonally. Doesn't mean it's going to happen that way. That's just what has historically happened. Looking at the NASDAQ, we're over here in this red box where we might be coming into a period of some weakness, seeing kind of that same thing with the S&P 500. And then here's another bit of research put out by Carson. Stocks love Monday and Friday in 2023, where we're up 72.7% of the time on Monday, and we're up 53.9% of the time on Friday. So the scenarios that we're going with in the daily charts, we cannot justify going down right now. There's always warning signs. I look at so much information. It's never black and white. It's always kind of gray, but the evidence is just suggesting that we're looking more positive, but we are overbought right now, and we're coming into a holiday week. So we're going more with the upward scenario, and we're not going with the sideways scenario right now, because the ADX on the short and intermediate term charts are showing that we're in a strengthening trending environment. So the warning signs, this is just for Monday. The long-term equity put call ratio is going up. That's negative. The risk on posture, it's ticked up a little bit, but it's still been declining longer term. The 50-period exponential moving average study of the new highs, new lows that we do, it's just barely trying to cross back above zero. But for right now, it's still negative. The Russell, the small caps, and the mid caps have recently generated death crosses. The financial sector did generate a death cross a few weeks back, but it spent the last week to week and a half above its 50-period and 200-period simple moving average. It may be able to generate a golden cross, but it's not quite there yet. So looking at the longer term signals here, the weekly S&P and NASDAQ 100 chart, we're still below those longer term trend lines. The cumulative new highs, new lows for the NASDAQ, they're still going down in the aggregate there. The 3-month yield, it's starting to roll over. I say it's rising here. It's actually starting to decline, but we don't know if this is going to be relevant or not. And then earnings season is pretty much on a case-by-case basis. The positive things, the daily special K chart has turned back to positive, but the weekly chart is still negative. On a momentum basis, the S&P and NASDAQ 100 are positive. The 5-period equity put call ratio is back to going down. That's positive. The parabolic SAR and the vortex are positive, but be aware the vortex is looking kind of toppy right now. The bullish percent index for the S&P 500 is above 50 and advancing, and that's positive. Small and mid-cap growth, it's been chopping sideways, but it still is positive. The longer term, we had another ZWAG NYSE breadth thrust buy signal that was generated. That was a couple of weeks ago now, but this stays on the books indefinitely. Seasonally and historically, November is the best month of the year. Longer term positive seasonality and setups that I talked about with some of the earlier charts, those are still there. The S&P remains above the downtrend channel upper line. I didn't show that chart in this video. I'll show it in the deep dive video. So our conclusion for Monday is that we're positive and overbought in the short intermediate term, but we're still positive in the long term. Thank you. I really hope you found this helpful. I hope you have a really wonderful weekend, and I will talk to you in the next video.